Welcome back to Money Never Sleeps. We have a pretty packed show today. A lot of stuff we got to get into. So let's just get into it. Here we go. Welcome back to Money Never Sleeps. Excited to be here today. Lots of stuff coming up. We got House joining us in a few moments. No worries. Before we get into anything, just we're not financial advisors. Nothing we say or do is financial advice. If you want to seek financial advice, you got to find one of those on your own or do your own research before you make any financial decisions. We can never persuade you to do anything. Everything's on your own. So that said, out of the way, today's big day. We got OPEX. We got a ton of other stuff coming up. We got a lot of data out of Europe. We got some data out of Asia as well. Got some more layoffs out of the automotive industry, which we kind of talked about yesterday. It's a pretty packed day, and it seems like the markets for the most part are a little bit split. We're taking a look at we'll take a look at some of the small caps. We'll look at the Russell 2000. We'll look at the Dow, the S&P. All those are pulling back. The NASDAQ for the time being is up right now, but here my friend House is joining us. There he is. There's the big man. How are we doing today, House?
Doing well. It's been a long morning. Was up until like 4 a.m. or something like that, and then my boss called me right at 2:59. I looked down and I was like, "Oh shit, stream started. Gotta hop in here." I'm late, but now excited to get into it today.
Nah, dude, you were totally fine. I was just telling them what's what in the market right now. I've been actually away from the markets all day today too, so I just started doing a lot more research on what's going on the past 30 minutes or so. But last night I was up late too because we got a ton of data out of Asia, a ton of data out of Europe and Eurozone. Things aren't looking good. But again, I think they're going to try and spin it any way possible right now to make it seem pretty, I don't know, make it look pretty good for 2024. But that being said, is there anything that you've seen in the markets that you think we should talk about today, and then we can kind of get into some of the stuff? Anything that I'm missing out on, just let me know.
I have a feeling you probably already touched on it, but the 100 billion plus cash injection into the Chinese economy.
We're gonna get to that. Yeah,
that's definitely a zinger. Crypto is just bouncing up and down. I have no idea what's going on there. It's like one day we're up 15%, next day we're down 15%. What's going on? But no, we've just been getting interesting stuff across the board. So you drive the ship and we'll take it wherever you want to go.
Absolutely. Crypto is doing ping pong. It's honestly the least interesting out of everything that's going on right now, because I just think we're in liquidation season. And, I've been following the funding rates and everything. We'll take a look at that stuff later too. A lot of stuff we can get into today, but we know that today is OPEX. So a lot of calls are definitely in the money today, just how much this market has moved recently. So I think that us seeing a bit of a, lackluster day in the markets itself is just kind of profit taking. But there is one scenario that I do want to talk about, and maybe we can start here today. And it's the real reason why the Fed is cutting rates, or at least looking forward to cutting rates in 2024, right? So what I'm going to do here is we're going to take a look at the bond market. I know, boring stuff once again, but let's take a look at the 10-year, and we'll take a look at the 2-year treasuries and take a look at why something happened in October and what that potentially could be, because something definitely did happen in October, and you're going to see exactly what I mean. So these yields, this is the monthly, and we can see that the yields obviously were pretty lackluster here for a decade. Obviously, they were higher back in the 90s, 80s. The 80s fucking yields were insane. But as of recent, when we look at this, something happened back here in October that just pretty much meant that, okay, maybe we did peak in the bond market. And the question is, why did the bond market start to, finally squeeze a little bit? We're starting to see people who are, we saw a ton of people who were short, and we talked about the short positions yesterday on the bond market and how that's going to impact a lot of people. And, there's probably good speculation that the VIX is going to be reacting to this because people are blowing up the trade with margin. Now, the question is, who's been buying these bonds and why October, right? because we can see here, like, yeah, we had a bit of a consolidation period, but this is a massive sell-off in the past 2 months, right? We're down, 9.43% in the 10-year yields just this month alone, and then 12.26% in the month prior in October. So something definitely did happen, and we could take a look at, the reverse repo and a bunch of other stuff like that. But if we look at the 2-year, it's the same story, a little bit less, 8% last month and 4.75% or so this month. The question is, who's been buying these bonds and why are they doing it? So I have a theory, maybe put on our conspiracy theory tinfoil hats here. I think it's the investment banks, right? I think it's the investment banks, and I do think that it's also a lot of other maybe nations that do want to have some U.S. debt going forward if they know that these yields won't be there in the coming years probably. And that's why we're seeing the long end of the curve kind of get bought up here right now, because they're locking in those gains for as long as they can, because there's a good chance that if we are heading to a deflationary period in the global economy, which I do think we are, we can make a case for that today with some of the data that we got out of Europe and also in China. I think that we are seeing the institutions that have their ear closer to the ground, that know that liquidity is going to be an issue in 2024. They say, you know what, we got the trade wrong in 2021, 2022, because the yields were so low that we don't want to get hurt by this again. Let's take advantage of it. We know that the Fed is going to cut rates in 2024. Everyone's talking about inflation resurging. I don't think that's going to happen. I think we're in a deflationary period, and I think the investment banks know that, and a lot of people with a lot of capital know that, and they're just locking up, and that's why we're seeing this massive squeeze on the bond market. Now, that's a scary thing, because I don't actually have the answer what happened in October. We're starting to see a lot of things in the Euribor and the SOFR charts that don't necessarily seem like there's going to be a lot of positivity moving into 2024. And we're also seeing equities rally while the bond market is also, squeezing a bit here. So it's a very interesting thing that I saw in the charts. I am pretty convinced that that's who's been squeezing the shit out of these bonds. It just makes the most sense to me, I think. And then once we look at the reverse repo again, and maybe take a look at that right now, we'll pull up the box score. I mean, this thing's at 769 billion, and it's been dropping nonstop over the monthly. We can see that we're on track probably for early 2024, maybe Q1, to see this thing completely drained. And I think even today, I think out of 82 participants that took part in the reverse repo, I think it was in the 600 billion range. So this thing has a good chance of just continuing to bleed out sooner than people anticipate. And that's a very scary scenario if you know that the bond market is also kind of presuming that liquidity is going to be an issue and these yields might not be there come Q2, Q3 of 2024. So yeah, it's just something I noticed. I don't know if you had anything to add to it. It's
No, I mean, I think it's a really interesting scenario, right? Because we saw a bunch of funds and a bunch of banks loading up on US Treasuries for months on end, right? And it was honestly, I can understand why they did it. You had some pretty ridiculous yields going on. If you look back at the beginning of the year, and it's something that J-Web said, and I mean, it honestly held true up until the end of October, right? Like,
yeah,
you could have put all the investment money into a 6-month treasury yielding 5%, 5.5%, and it outperformed the crypto market and some of the other markets over that period. But now we're getting to a point, right, where, like you're saying, you're expecting deflation. Some other people probably are too. Some of the banks are realizing, like, hey, we've been pigs. We've been getting fat. Let's not become hogs and get slaughtered if this all comes tumbling down. Let's start de-risking. Let's start selling some off, and probably keep some debt, because you want to have some of that just in the back pocket, just in case. Don't want to completely liquidate the position. But no, I think it's people are starting to realize the run's been long, it's been strong. Let's come out on top and realize some profits heading into 2024.
And that's I agree with you 100%. And it's the scary thing that I can't get my head around is what happened in October, because it's almost similar to what happened from November to December when the Fed had their meetings, right? They said that, we're not even talking about rate cuts. That was the headline in November. Come December, yeah, we're in the dot plot. We're expecting at least 3 come 2024. Something happened in October to where we are today in December, where they announced it, and the bond market kind of knew this was happening. I mean, we're down 20% since the height in October, and we've seen the reverse repo just absolutely accelerate since then. So there's something that we don't necessarily know that the equity market is obviously a lagging indicator of what's potentially going to happen moving forward. And again, people are getting Jim Cramer, I'm bringing him up because that's just the guy who's saying that the Fed got a soft landing. They did it right. And also the equities are going to probably rally moving forward. And people are also saying that the small caps are going to rally. So we can talk about small caps next, but something definitely happened in October. I want to investigate this more. And I want, you and Jay Webb also, it's just for us all to be following this, because I think this could be essentially whatever happened in October is the reason why we are seeing the Fed start to be a lot more dovish, because they weren't this dovish in the last meeting. They started to lean this way, and sure, they didn't cut this time, but they're kind of hinting that, hey, maybe participants that are big players, it's like, this is kind of, we're showing our hand, prepare for the worst because it might be coming your way. So good transition, I would say, into that would probably be looking at the small caps, because everyone on CNBC yesterday was saying that small caps have a great chance of going up 50%. Some dude on fucking CNBC yesterday said the Russell 2000 could be the Russell 3000 by next year. I'm like, all right, buddy, let's take a look at this and see what's going on here. So obviously I'm looking at this on the monthly, but let's look at this on the daily. And, it's a very complicated structure. By complicated, I mean, it's a boring consolidation pattern. It's a triangle, but you can try and match it up as much as you want. We can even delete some of this, but we can see that we are just hitting resistance nonstop at this level around 2000, right? And we always say that the small caps are kind of the sign how the true economy is going, because obviously, large caps, the Magnificent Seven, they are telling a different story that is, different from what the consumers are pretty much, taking part in every single day. They're not profiting from consumers the way that a lot of these companies in the Russell 2000 are. Consumers, yeah, exactly. So when we look at this, I just keep finding resistance, and everyone was saying that the Russell's going to break from it. I wouldn't be convinced that this move is going to the upside and this is the bottom here, unless we break obviously 2135 or so, right around here. That would be out of this channel, and I think that would give us a good indication where we're probably going to be heading. But once, twice, three times, four times the charm, right? Stochastic RSI is over at 100 and 100. It can't get more overbought on the daily. Could it go up? Yes, absolutely. But it's overbought completely, and you got a really good gap right here, and you got a pretty massive market maker pattern to the upside here, and you're also going to get a golden cross on this. I think it's too good to be true. Could we definitely be, consolidating in this range for a few days into the end of the year? 100%. I think that's very possible. But we do know that Q1 is going to bring Q4 earnings. I get that so messed up now that at the end of the year. I keep saying Q1 earnings, but it's Q4 earnings that we get in Q1. A lot of those companies, I think, are going to be hurting a lot more than people anticipate. And there's a good chance that this right here could be the top, the absolute top, I think, for the year, and also going into 2024 for the Russell. And we could start to see this absolutely reverse if those Q4 earnings are absolute dog shit, which we're kind of getting our hands seeing how many layoffs these companies are already, predicting. I don't think that's because of the vibe session. I think that's because demand is genuinely drying up in the, U.S. consumers, for U.S. consumers. Let's see here. So, yeah, small caps, I think, are going to tell a lot going into next year. It's nothing too crazy right now. Obviously, today we're getting a bit of a sell-off in the S&P, 0.17%. That's nothing. We're seeing profit taking, people closing positions. The Dow's, down 40, Nasdaq's up, 72. It is what it is. It's nothing too crazy. It's pretty much the same trend that it's been going forward. I think next week's going to be a little bit more interesting once we get PCE data. What's having a really good day actually is the dollar, given that it's been on a massive sell-off recently. We could see that the dollar is up about 0.5% today. This could be one massive five-way move down here, and we're still in this bull flag. And as long as this daily stochastic RSI starts to reset, gets below, the overbought, it's out of the middle range and it's starting to be into the oversold territory, I feel very confident that this move to the upside is coming for the dollar. I've not given up on the dollar one bit, and I think a lot of that does come from liquidity, and I think a lot of it does stem from what's going on in Japan right now. I think a lot of people are thinking that Japan is going to do rate hikes. I question that. I think that they might not even get to that point, because some of the data we got out of Japan today, it's not necessarily that great. So let me pull up what I'm looking at from Japan, and you can tell me if this seems like they are having an inflation problem or they're having a deflation problem, because I think the market has it wrong once again. Let's see this breaking news. Here we are. Yes, I'm obviously using Twitter, but Japan's S&P Global Flash Manufacturing PMI for December is at 47.7, down from 48.3 in November. So they had a little spike of inflation recently, and they were talking about maybe we need to get away from negative rates and we have to start, rate hikes once again. And that just absolutely blew the minds of everyone in the market. They were getting out of the US dollar. The yen was growing crazy against the dollar. It was causing the dollar to crash. And then we see something like this where it's like, oh, maybe they just had a period like a month or two of where inflation did spike a little bit, but now we're starting to see demand kind of diminish here. So that's what I'm seeing from it. I wonder what your thoughts are, because I think we both agree that Japan is a huge player in what happens in the global economy and a huge player for what happens next for the United States.
Yeah, no, I mean the implications of Japan really moving a hard direction either way has a major swing on the US, right? And not just because they're, I believe, the second largest holder of US debt, but also based off of their geopolitical position, right? You've got them as one of the kind of allied, so to speak, strongholds. We have great relations with Japan, right in the middle of Southeast Asia. So, when you get that brinkmanship with North Korea, tensions with China, a lot of instability in Southeast Asia, Myanmar, as it was formerly known, Burma to be specific, they've been in some sort of junta civil war for years now. And that's kind of just been the trend with the region. Having Japan as a strong ally there is very important. And also, just if they start offloading US debt, that kind of forces other major parties internal to the US, as well as other foreign debt holders, to start considering their positions, right? Because everyone is going to be all eyes on them. So, anything that Japan does, I think a lot of people don't pay as much attention to as they should, but it's really kind of one of those things that you can look at and almost kind of be a leader, or not a leader, a leading. It's hard to even call it a leading or lagging indicator, but it's just at some sort of position, right, where they have so much influence that most of the retail side doesn't really recognize. But if they take some major action, like I said, it's just a big swing either way.
Yeah, definitely. It's really weird with Japan too, because obviously they are an aging population too, right? And we know that they're also a huge importer as well. And we knew that oil was kind of a problem in the months prior. Them maybe importing oil is maybe caused a lot of their CPI to go up. I think that was a huge part of it. Now that the demand is dropping pretty significantly, we're starting to see, the manufacturing drop a little bit. I wouldn't be surprised if we continue to see their CPI drop. It's not as hot. And if they're talking about rate hikes and they start to see this data kind of change, well, then maybe they don't. And that's going to, pretty much just make the dollar stronger against the yen. That's just naturally it is. I think people also underestimate how much strength the US dollar does have over the yen and how much it's easy to control based off of whatever policies the US, decides on when it comes to Japan and, foreign relations.
Well, and part of that too, I don't mean to interrupt you, right?
No, you're good.
One of the things that people love to say about the dollar, since, it's not backed by any sort of commodity or RWA, right, is the value of the US dollar is how many ships we can park outside your land and say, hey, the dollar's worth what the dollar's worth.
Exactly.
At the end of World War II, as part of the Accords, Japan hasn't really had a large standing military. And if they get attacked, they're heavily dependent on the US fleet in the region, right? The US has a large naval base, I believe, on Okinawa. I think it's Okinawa, but one of my buddy's moms was born there. So we always joke, even though it was American soil, she's Japanese. But no, to bring it back to my point, it's, Japan, even though they have the influence, they hold that much debt, they also have to realize, right, the value of the dollar needs to be strong, because if they try and influence the dollar, you don't know what your defense looks like.
Exactly. That's 100% great assessment of pretty much, like I said, the influence that the US dollar does have over the yen. And the other thing too is pretty much, the yen is also impacted by China as well. We can get into China now because we know that China is a massive exporter, right? They're the world exporter, and they are seeing declines in the amount of exports that they are sending out. So if we take a look at what China's been doing recently, and I know that they said that they weren't going through a period of deflation. That's what they announced yesterday, and they also announced it I think it was a few quarters back. But let's take a look at what they are currently doing. And we can see that the People's Bank of China is carrying out a record liquidity injection. I believe it was offering 1.45 trillion yuan, which is about 200 billion US dollars worth of policy loans. And if we take a look at the Hang Seng index, we can see the exact moments that this news hit the market because it absolutely just shot it straight up. Let me pull up the Hang Seng real quick. But this is another round of liquidity that they absolutely injected into the market. It's not the first time. And we know that, and I'll say this, the more government has to do doesn't give me the confidence that things are okay in the free market. That's pretty much what I think people need to remember when it comes to seeing news headlines like that. So we can see this move up here. It shot all the way up, and it got rejected right here about around 17, 16.9 or so, 17K, closed around 16.7, 16.8. We got a massive gap here, but you can definitely see that this was a massive move, and just people in the market just, bought on that news alone. I know that they have also injected liquidity in the ranges back here, and we can see that there is a bit of a pump, and then you start to see it slump. I want to see how sustainable this is. This is not that necessarily a great move. And again, we got this news on a Friday. Got to wait till Sunday night, for their Monday morning to see how the markets open up on that news. But if nothing changes, there's a good chance that we could be testing the bottom channel of this parallel channel once again. That's sub 16K for the Hang Seng. And we could be looking at breaking that and going towards, the COVID, not even COVID lows, the October 22 lows, which would be, somewhere in the 14.5, 14.6 range. And I'm not saying it's going to happen instantly, but we do know that there's a lot of issues going on over there. We saw that Country Garden is restructuring some of its debt, selling off some of its assets in hopes that people start buying again. This injection of liquidity is just hoping that they can loan out money to willing borrowers to the point where they can, start buying property once again to kind of revitalize some of that property market that's, kind of rotten right now in China. But the question is, if people are given money, are they going to spend it? I don't think so. I think if people know that the economy is bad, I think they're going to hoard cash. And that's not saying something about the people of China. That's just saying something about consumers in general, right? If they know that there's not a lot of money out there and, prices are going down, well, it makes more sense to hold on and maybe buy it another day because prices are going to continue to go down. So this is really kind of I'm not going to say a last stand, but it definitely seems like we're running out of options when it comes to trying to drive demand in some of these countries that are seeing massive, massive reduction in demand.
Yeah, no, I agree. I guess my question for you would be, at what point, if we continue to see China go down, these cash injections fail, market continues to go down, we start to see more fallout from Evergrande and part of the real estate, we'll call it a mishap.
Sure, I agree. Yeah,
it's not over yet.
Exactly.
But what do you think that not necessarily timeline, but what is the series of events that causes the fallout to leave China, right? Like if the full impacts aren't realized now, what do you think it takes? Does the Hang Seng need to continue to drop? Do we need to see, another big real estate or tech conglomerate go down? What does it take?
I think what would probably happen next would be something with the banks over there. And I also think it would be something probably with a bank that has international exposure, both to China and some other part of the world markets. I have an idea who that is. I'll say a random bank next, just so people kind of have an idea of a bank that I'm looking at. There's two actually. HSBC. I think that's one that we have to keep an eye on. I'm not saying there's anything wrong there, but I do know that they have a huge amount of real estate exposure, both in China and also in Europe. The other one that I would say is going to be complicated might be something like Deutsche Bank, which does have, derivatives and whatnot for, Japan, which is also exposed heavily to China just because proximity, how close they are in general. So I think that we could see contagion be something that spreads out of China into one of the other markets. Eventually, these are going to either end up in settling or they're just going to have to liquidate assets. And that's just going to bleed throughout the entire banking sector over there. And it's not going to stop there. It's going to continue into the other ones. And we do know any bank that right now has any significant exposure over there is probably biting their fingernails, hoping that things get figured out. But, they're probably getting to the ends, probably got nubs at that point. So that's how I see it playing out. But do I think it's going to stem from China first? I don't necessarily know. I think that there's things that are equally as bad, if not worse, in other parts of the world. And to that, I say we should take a look at what's happening in Germany and France, because they're also getting some really bad data. And we're going to talk about how manufacturing data and services sector are pretty much linked one-to-one. So we're going back to Twitter, and we can take a look at manufacturing services and composite PMIs for both Germany and France. And these are the two that have been lagging the most across all of Europe. You can throw Switzerland and maybe the Netherlands in there as well. But for the most part, I think these two economies are really important. And when you see this, you can see that's the survey, obviously for French manufacturing was 43.3. The actual came in at 42.0, and the prior was 42.9. So definitely below expectations and below the prior reading. We know that if manufacturing continues to go down, what's coming next? Services sector. Services came in at 44.3 after being surveyed at 46, and the prior was 45.4. So that is dropping like crazy. And we can see that as manufacturing contracts, services follows right after. Can it take a little bit of time? Absolutely. But we're starting to see that over there. And if we look down to Germany on this, you can see that's in their PMI for manufacturing. They hit 43.1, it's 0.1 less than their survey. And, 42.6 is their prior. So up a little bit there. It's a pretty good read, if anything. But we see over here that the services is dropping. And I think that's kind of following, the recent moves in the manufacturing. It took a while for services to start contracting, but 49.8 was a survey, came in at 48.4, big drop from the previous 49.6, over 1.2 points. And if we see the, composite here, it's, 46.7 against the prior 47.8. So a little bit of a rebound in manufacturing, but that doesn't mean that the services sector and manufacturing are done contracting just quite yet. I think that we are going to continue to see the services drop in Germany. Maybe they meet in the middle somewhere, but neither of these two readings are great by any means for the Eurozone. There's a lot of complications for Eurozone. I know they're not talking about cutting rates. They might have to at some point if one of these two economies just absolutely blow up. I know there is a lot of fear right now in Germany about a financial crisis. I can't remember what, I think it was the Green Liberal Party had made some, announcement about that earlier today. Question is, does anything happen before something catastrophic happens? It really depends on, I think, one of these two economies that are pretty much signaling that, hey, things are slowing down and they're getting bad pretty fast.
Yeah, no, I mean, it's been interesting too, right? Because I remember back at the onset of the Russian-Ukrainian war conflict, I'm not on either side, so I don't really know how to properly deem it and not offend anyone. So sorry if I offended anyone. But Germany's been in a really interesting spot, both from an economic and political standpoint, since the onset of that war, right? Because back when winter was approaching, after the war had lasted 8 months, no one knew, where is this war headed? We all thought this was going to be a 30-day, 2-month, max conflict. Everyone was very worried about energy in Germany, right? They're like, we're running out of energy. They made it through the winter, they made it through 2023, but then they ended up in a technical recession. And then at the meantime, you've got an issue where the German population, or a portion of the German population, is starting to lean further right than they have been traditionally and for the past few decades over immigration. That started gearing up a lot of people. Italy was facing something similar, but you've really got the German economy in a state of unrest. But like, it's like, where are they going to go from here, right? And just seeing where they're at versus where everything should be, it's like, I really don't know what's going on anymore.
Yeah, there's so many problems in, I'll say, Germany, Austria. We do know that's, I think it was, I'm going to forget the name. It's Rene Benko. It's his company, Signet, maybe. I can't remember exactly what it was. Pretty much they're a property. They own tons of properties across all of Europe, but Germany was one where they had a lot of offices, kind of like WeWork, and, tons of properties globally. But I believe that they went insolvent recently, like as a matter of like 2 weeks ago or something like that. So there's a lot of issues right now in Germany. And, I pulled up the DAX right now because this is kind of similar to what's going on in the US. absolute contraction in a nation, but the ECB is not cutting rates. Therefore, the stock market continues to go up. So they're in pretty much a manufacturing depression at this point, and soon to be maybe a services sector one too. But this is the all-time high. You know, we hit the all-time highs a few days back for the DAX, and that just means that once we do get kind of wind that they are going to start cutting rates, and if they start cutting rates faster than expected, I mean, they're kind of in a place where we're standing at the edge of a cliff, looking at the future, right? So I think it's kind of showing you that, hey, the economy can be terrible and the market can still go up. But once those rates get cut, and I don't know if we're going to be the first ones to do it, I would anticipate we're going to be the first ones to do it since we announced it. We could start to see that tail off and in real time. I mean, it would be ideal if we did see it over here first. So maybe US markets can kind of react like, oh, maybe we're not in such a great place. We probably would, you know, ignore it still. But it's definitely something that we are going to see, because I think that's going to be the catalyst for this DAX to finally start coming down significantly, especially from all-time highs. It's going to be when those rate cuts are announced.
Yeah, no, 100%. I think it's interesting too. I've kind of been pondering this thought in the back of my head, and I don't know why it came up now instead of we were talking about China, but like, I wonder if this kind of state of, you know, like almost a suspension of disbelief that we're having with this current cycle, like really hard for me to tell, are we in a bear trap? Are we in a bull trap? Or is this just one of those situations where we were getting so bearish over a long period of time, and governments are like, okay, we need to start easing back and scaling back and just try and get a massive cash injection into the economy. So let's start deflating, let's start lowering rates, let's inject some cash and see if we can pull a 2020, 2021 again and just somehow have that correct and fix the markets. Because like, and the reason that I didn't just immediately brush that off as just a ridiculous idea is like, look at the people in charge of our financial system and controlling our legislation. When you watch them on C-SPAN and you just watch some of those congressional meetings, you're just like, you know, you just sit there, you make weird gestures at the TV and you just shake your head. And it's just like, these are the people in charge of American society. These are the people leading the free world. Like, come on.
Yeah, you know, they didn't get elected for their knowledge of economics, right? And, you know, the fact that they're pretty much coming up with a lot of the laws and regulations for which we are pretty much operating in this market. That's how you know that's, you know, The Big Short, if you ever read that book, that nobody knows fucking anything. Doesn't matter if you're at the top or the bottom, everyone's stupid. And when money's stupid, they realize a little bit too late, oh, we're on the wrong side of this trade. So I think that's, yeah, they definitely, I mean, they did it in what, 2021 or 2020, 2021, they injected tons of money into the system. I think there's a lot of data that people are just ignoring now that is kind of, I mean, it's just giving, it's allowing me to sleep at night as a bear, knowing that, no, you fuckers are lying to yourselves about this. It's a terrible lie that, you know, we're hitting for a soft landing. No, this data is 100% on par with everything that we've seen in some of the biggest recessions in the past. The interesting thing is still, people will say that, you know, it doesn't matter, any of that data too, right? None of that data matters. You're just saying it just happened to line up with that. And I think people are aggressively thinking that this time is different, or, you know, that's not data that we're looking at. That's just kind of similarities that we've seen between previous cycles. All right, whatever. We'll find out in about 6 months. That's, I think that's the only thing we can kind of say at that point, because we're going to find out who the fuck's right and who the fuck's wrong. And I have a funny feeling that it's not us. Let's just put it that way. But yeah. And here, we'll just pull up this right now because we talked about it yesterday. Fucking auto market, dude. GM's laying off 1,300 more people in Michigan as vehicles end production. Now, what did we talk about yesterday? We literally said that the UAW strike impacted their profits, which we're going to find out in Q1 from Q4 earnings. I got that one right that time. And we're also going to take a look at, you know, how oil is definitely impacting this market. The less demand there is for oil, the less demand there is for vehicles, the less demand that they're going to need from people on the assembly line manufacturing. And that's just going to, you know, it's a vicious cycle. It's going to keep, you know, repeating itself. And we're going to probably start to see more unemployment continue. So they might have got a great contract, but they're probably going to, it's going to be short-lived, you know, some of the benefits of seeing, you know, those wages going up, because I think that no one right now in their right mind is buying a vehicle. And even if used vehicles do come down, does anyone have the cash to purchase it? I think not. So this is another thing that's just telling us, it's like, okay, unemployment is going to rise. I think we're on par for 27,000 layoffs in the month of December. We're either at that or we're above that, and it's only December 15th. So that's a very interesting thing. And I think the layoffs are down a little bit because people are anticipating, you know, seasonal jobs and everything for hiring. So people kind of need people just through this season. I think the layoffs are going to continue into January. I think they're going to continue into February and March. Once seasonality is over, we're going to start seeing big picture how much demand there really is in this market. And I think that them announced that they're going to cut rates, and we're also getting it right now when we're about to get Q1 earnings or Q4 earnings, and Q1 fucked it up that time. And we're going to see exactly what demand there is out there and how strong a consumer is and how strong the credit cards are, you know, are for at least lending out credit, because we know that's drying up as well. I mean, unemployment's coming hard, and I think the auto market is just one sector of the economy that is seeing this, and once again, all leads up back to demand. So I'm not convinced that we are in a soft landing.
Yeah, no, I think you're right on the money. I know we're cutting it close on time, but I think we should take a look at crypto real quick.
Oh yeah, absolutely.
There are two things I want to look at. The first one, and I can't believe I'm saying this, pull up Solana.
Oh, I thought you were gonna say Bonk, dude. I was gonna be like, "Fuck you."
Oh, well, no, I mean this. It
I'm just fucking you, man.
Bonk too. Because Bonk's part of the story, man.
I know Bonk's going crazy. Get bonked.
Well, so if you weren't on Twitter yesterday, or at least the crypto Twitter sub niche, then here's the story you need to hear. Solana, you know, they announced the Solana phone last year. I think it's called the Saga or the Sega, something like Saga, that. And that was right after the whole, or a few months after, like FTX, and everyone had the suspicions that, you know, FTX is tampering the chain. It crashed from 180 to like $9 or something like that, right? So Solana's just been the laughing stock of crypto Twitter, other than maybe Cardano, but like people don't even care enough to trash Cardano.
Yeah.
So Bonk coin Kevin mentioned, this thing's, I think it's at like a 4,000x right now. It topped $1 billion market cap. It's getting listed on Coinbase. It's like the horny dog Bonk meme, right? Where Shiba's got the bat on Sol, and people are just loving it because there's really no gas fee when you're trading meme coins on Sol, right? So it's like, even if it goes to zero, you don't need to pay the $20 up front to swap the coin. So Solana, they got the phone on discount from $1,000 to $600. They offered a free month of Helium mobile phone service. So if you actually wanted to use it as a phone and not just a little DAP tablet, then hey, you got phone service. The equivalent of like $877 worth of Bonk. So if you swap it to Sol, you're getting 12 Sol. And then there was also just a bunch of other perks, like something like instant qualification for airdrops because it would have all this activity or something pre-programmed, and just all these insane things where there was a $277 arbitrage opportunity to buy a phone. Like you could just go get the free phone, right, and walk away with $277. Sold out in the US by the time that I was finally like, okay, I'm gonna check this out. If this is real, I might buy one. Sold out. I was kind of pissed in the moment. But yeah, I mean, if we want to take a look at Bonk, just because that might be the most ridiculous chart ever, like I think it honestly might be more ridiculous than Pepe.
I mean, let's put it this way. Is that the chart? Look at this, dude. Yeah. But here's the thing, Bonk, let's see, what was the exchange that it was on for a long time? Because it's not a new coin. It's been on for the longest, hasn't it? Like over a year now.
No, I think someone dropped the new Bonk.
Is that what it is?
The best place to pull it up would be birdeye.sol, or birdeye.so, I think is the domain ending. But it's all because all of these charts are only going to show the history since it got listed on each respective exchange. and I don't know if TradingView supports Solana liquidity pools.
Gotcha. Let me pull up bird.so, and it's Bonk. Oh, Bonk 2.0.
That might be it. Whatever one's at $1 billion market cap.
Probably this one. Let's see. Is the 15 minutes? Give me the daily. Oh, that's fucking wild. Yep. No, that's max total supply. I'm just using a new website for the first time. Bear with me. I'm being stupid here. What the hell's the market cap? It's got to be it. It's the number 2 pair. It's Bonk against USD.
Okay, yeah, that must be it. I just figured that for the full history on Bird Eye, it'd probably be a even more pretty chart.
Let's go to an hour. It's maybe that'll give us a better. It's betterish. Let me see. I'm not even sharing the screen. I'm an idiot. I'm an idiot, guys. I do this all the time. Let's do it. All right, here you are, Bird Eye. That's what I'm seeing here. Go here. Yeah. What says it's on a TradingView? That's wild. I guess that's where it's pulling it from. All right, let me just go back to TradingView. I'm being stupid.
So it's down a little bit, but I mean, man, I knew a guy who's just kind of one of my timeline trading buddies. We ran into each other in a few consecutive projects, ended up following each other, shoot the shit in DMs every now and then. And this dude will ape into literally every shitcoin that comes out. He's got one of those bots that scans contracts as they're deployed. It'll do the deck screen for him, and it'll say like, hey, this is going to drain and rug you or be a honeypot instantly. Or, hey, you got like 5 days to figure out if they're just going to rug it and take all the liquid, right?
Yeah.
I think he put 500. That sounds right. $500 into Bonk. He cashed out, I think, 75% of his bag. What's your guess on how much he pulled out?
Well, I mean, the fact that I just saw that it's up fucking 4,000% in like less than a month. 500 times, I don't know, dude. He probably netted over 100K, right?
162K, and he's still rounding some. And he sent me a DM, and he was like, dude, check my tweet. Like, I'm in shock right now. I looked at his tweet. I'm like, this Mfer made just over 162K, like, you know, a couple $100 and some scratch what's now changed for him. And I was just like, is it Soul meme coin season? I guess it is.
Dude, I hate meme coins so much.
Dude, we got Sagas sold out in the US. They're only available in Europe. They got a couple left, and we got Bonk looking like it's going to be the next Doge. People thought it was Pepe. People thought it was ticker Bitcoin. It might be Bonk.
Dude, I'm baffled because I'm a very logical person. And I know if I try to apply any logic in the technical analysis of this shit's going to dump on me because it's not logical. But as soon as you start seeing people pile into it and you think, oh, it can't go up any higher, it goes up higher. This is like, you just have to have absolutely, like, I'm not saying anything about anyone, but you kind of have to have like that no branch, like, fuck it, YOLO, throw my whole life savings into it. And you see those returns like that. Like, I can't make sense of these.
No, I mean, that's a great point, because like, realistically, if you have the ability to hold any token, regardless of your bet, whether it's spot or levered, and you go from like $100 or $1,000 to $100K or $1 million, that's bad risk management, right? Oh, yeah. Because you should be taking money off the table and not just riding it all the way up. And it's just, but at the same time, it's like, that's ultimately what it takes if you want to do it fast. It's a lot more risky. It's literally gambling, but hey, I mean, if you can walk away with that much money, just make sure you go put it in a money market or something else, cover your tax obligations, and, you know, go enjoy a mojito, go get a glass of rum.
Definitely. If I would have done that, made 160K, I would take in profit, put 37% away for the IRS, because we follow the rules here on this show. Mm-hmm. And then I would have bought definitely some type of treasury yield that's at least giving you that 4 to 5% before everyone started squeezing it. But I mean, congrats to that dude. I mean, that's an amazing gain. And I have no problem with people making money in this market, and you got to have some big balls to even take, to let it ride continuously to the point where you make that much off a $500 bet, right? I think I shorted the US dollar a few days ago, and I made I think like $800, and I was like, hey, it's great. That's not bad. And then you think about, how conservative that is, even though I know it could have, made some more money. And then some people are just like, yeah, screw it, whatever. 160K of $500. It's
dub's a dub.
Gotta love crypto for that. There's a lot of success stories, and you just hope that they continue to surprise everyone. Hopefully you catch one of those fish one of these days. But anything else you want to take a look at in the crypto market? I have nothing. I am absolutely just looking at liquidations and crypto funding rates, and it seems like everything is still red in the positive. So it tells me that they're just building liquidity below.
Yeah, I don't think we need to pull up the chart. The one thing I will give a golf clap to and hats off is Parallel, their token Prime. It cracked $11 yesterday, ran up to 1180, 1185, and it's retraced slightly. It's under 11, but it's pushing back up. So man, that combo AI gaming token, people are loving the narrative. They're loving the game. They're loving everything about it. So
I'm so mad. So mad. We saw that one is $3.
Yeah, no, but I think that's a good time to wrap it at a good little chat. Covered a nice range.
Quick question before we head out, though.
Yeah.
Right now, what do you think is going to be the next big thing in altcoins in the next bull market, the next narrative? We have AI right now. What do you think is going to be the next big one? I have an idea, but I want to hear what you have to say.
It's tough to say. I don't really think. I mean, there will definitely be a basket category that overall wins, right? But I think realistically, there's going to be a layer 2 scaling solution that is going to show itself over the next 1.5, 2 years as our tech is fundamentally better than our competitors. Because right now, no one's doing that, right? They're still figuring out fraud proofs or other technical infrastructure issues on different ends, depending on where they're at. But at the end of the day, it's like someone needs to eventually differentiate themselves. AVAX has had a pretty nice move as a L1. But I think gaming tokens and AI tokens, those are, seemingly heating up right now, probably hold some promise. But I think the other thing too is going to be some of the layer 3s that are popping up and some of the AVAX subnets that are offering nodes. Right. Because I think at the end of the day, you can hold the token and you can buy spot. You can just hold the milk and drink it, or you can fucking own the cow and you can milk the cow and start printing milk, right? So at the end of the day, it's still a bit of a risk because the chain needs to be successful. It needs to get that transaction volume and throughput in order for you to recognize any gains. But yeah, I think you could look at AI tokens. I think you could look at GameFi tokens, and then I think different subnets depending on if you're convicted and what they're building on, and some of the layer 3s. Like there's one layer 3 that I'm familiar with. They actually just did their node sale. It's called Zai. It's a gaming. I don't know if it's a layer 3 or a side chain of Arbitrum. I believe it's a layer 3. But they did their node sale, and they've got a bunch of games coming out. So that could be one. I don't hold any. I didn't participate in the sale, but I gotta do some research on that one.
Nice. Yeah, I agree. I think AI is going to be continuously big. I'm going to go and say privacy / cybersecurity. I think that a lot of things are going to be important moving forward, especially if AI starts to go forward. I think that's going to be my conservative old man bet that those are going to be very important as well. So that's all I got.
But privacy tokens could be big. I could see that.
Definitely. Yeah, we can get into that another day because I know you and I could talk about that all day long. But let's wrap it up here. We had a great week. There's a lot to look forward to next week. We'll be back with J-Web. Usual time. We appreciate everyone for being here. Randy, thanks for always being here. Everyone else who's usually here. Chris, Ace. We love having you guys here. Everyone else. If you could do us a favor, thumbs up, subscribe, comment. If you're already subscribed, good job. You guys listened last time. But that's it. Have a great weekend, everyone. We'll be back Monday. And take care. Stay safe.